Welcome to day 3 of our 30-day practical guide to building wealth through smart investing. Let's start with a simple question. Have you ever bought or sold something in a market? Think about what determines the price of an item. Sometimes prices go up, sometimes they go down. Financial markets work in a similar way, with prices changing based on supply, demand, and investor expectations. Today, we'll explore how these markets operate and why they're so important for anyone interested in investing. Imagine a marketplace where, instead of vegetables or clothes, people buy and sell ownership in companies, government debt, currencies, and other financial assets. This is the world of financial markets. These markets connect people who have money to invest with businesses and governments that need funding to grow. They also provide a regulated environment for buying and selling investments, making it easier for everyone to participate. Financial market is any place, physical or electronic, where financial assets are bought and sold. These assets include stocks, bonds, currencies, commodities, ETFs, mutual funds, and derivatives. Most modern markets operate electronically, allowing investors to trade from almost anywhere in the world. This accessibility is a key reason why financial markets are so central to today's global economy. Financial markets play several crucial roles. They help businesses raise capital by issuing shares or bonds, which can fund expansion, new equipment, or research. Markets also support economic growth by creating jobs and contributing to overall economic activity. For investors, these markets provide a range of opportunities to pursue their financial goals, and they make it easier to buy or sell investments by bringing together many buyers and sellers. There are several types of financial markets, each serving a unique purpose. The stock market is where investors buy and sell shares of publicly listed companies. The bond market allows governments and companies to borrow money from investors. The money market focuses on short-term borrowing and lending, usually involving banks and large institutions. The foreign exchange market is where currencies are traded, and the commodity market deals with physical goods like gold, oil, and wheat. The stock market is a marketplace where investors buy and sell shares of companies. Examples include the Nairobi Securities Exchange, New York Stock Exchange, and Nasdaq. When you buy a share, you're buying a small piece of a company. Stock markets are essential for raising capital and providing investment opportunities for individuals and institutions alike. In the bond market, governments and companies borrow money from investors by issuing bonds. Investors receive interest payments according to the bond's terms. Bonds are a way for organizations to raise funds for projects, while investors earn a predictable return. This market is crucial for financing infrastructure, public services, and corporate growth. The money market focuses on short-term borrowing and lending, often involving governments, banks, and large institutions. Investments here are generally considered lower risk, but may offer lower returns. The money market helps maintain liquidity in the financial system, making sure that cash is available for day-to-day operations. The foreign exchange, or forex, market is where currencies are bought and sold. This global market includes currencies like the Kenyan shilling, US dollar, euro, and British pound. Exchange rates change based on economic conditions, interest rates, and market demand, making forex one of the most dynamic financial markets. The commodity market allows investors to buy and sell physical goods like gold, silver, oil, coffee, and wheat. Prices in this market often respond to changes in supply, demand, weather, and geopolitical events. Commodities are an important part of a diversified investment portfolio. A stock exchange is an organized marketplace where shares of publicly listed companies are traded. Its main functions include matching buyers and sellers, promoting transparency, supporting price discovery, and enforcing trading rules. Examples include the Nairobi Securities Exchange and major international exchanges. These platforms help ensure fair and orderly trading. The primary market is where companies first issue shares or bonds to raise money from investors, such as during an initial public offering, IPO. The secondary market is where these securities are traded among investors after they've been issued. Most everyday stock trading happens in the secondary market, making it a vital part of the financial system. Many different groups participate in financial markets. Individual investors use their personal savings to pursue financial goals. Institutional investors, like pension funds, insurance companies, and banks, invest large sums. Companies raise capital or invest surplus funds, while governments issue bonds to finance public services. Brokers execute trades, and regulators oversee the market to ensure fairness. Brokers are licensed professionals or firms that execute buy and sell orders on behalf of investors. They act as intermediaries, helping investors access the market efficiently and securely. Choosing a reputable, Licensed broker is essential for safe investing. Regulators are authorities that oversee financial markets, enforce rules, and help protect investors. They monitor trading activity, investigate misconduct, and promote accurate disclosure. Regulation is key to maintaining trust and confidence in the market. Prices in financial markets are determined by supply and demand. If more investors want to buy an asset than sell it, the price rises. If more want to sell, the price falls. Factors like company performance, economic data, interest rates, and global events all influence prices, making the market dynamic and ever-changing. Several factors can impact market prices. Company performance, economic data, interest rates, inflation, political developments, investor sentiment, and global events all play a role. Understanding these influences helps investors make more informed decisions and anticipate market movements. A bull market is a period when prices are rising and investor confidence is strong. Characteristics include rising share prices, economic optimism, and increased investment activity. Bull markets are often associated with growth and opportunity, but it's important to remain disciplined and not get carried away by excitement. A bear market is a prolonged period of declining prices. It's marked by falling share prices, greater uncertainty, and increased caution among investors. While bear markets can be challenging, they are a normal part of long-term investing and can present opportunities for disciplined investors. Financial markets rely on regulation to promote fairness, transparency, and investor confidence. Regulators monitor trading, enforce rules, investigate misconduct, and promote accurate disclosure. Before investing, it's important to verify that investment firms and advisors are properly licensed in your country. Regulation helps ensure that markets operate smoothly and that all participants are treated fairly. It builds trust, reduces the risk of fraud, and encourages more people to invest. A well-regulated market is essential for long-term economic growth and investor protection. New investors sometimes make mistakes like following rumors, investing without understanding the market, ignoring diversification, making emotional decisions during volatility, or chasing recent winners without assessing risk. Developing a disciplined process and relying on credible information can help avoid these pitfalls. Let's look at Sarah's investment journey. She was initially hesitant, thinking the stock market was too risky. But after learning how financial markets operate, she opened an account with a licensed broker, diversified her investments, and committed to a long-term plan. By understanding market fluctuations and focusing on her goals, Sarah made more informed and disciplined decisions. Sarah's story teaches us that understanding how financial markets work can help investors make better decisions. Instead of reacting to short-term price movements, she stayed focused on her long-term goals. This disciplined approach is key to successful investing. Now let's apply what we've learned. In a group activity, participants identify 3 financial markets, describe their purposes, explain who participates, discuss factors influencing prices, and present their findings. This hands-on approach helps reinforce today's concepts and encourages teamwork. During the group discussion, consider questions like, why are financial markets important? Why do prices change every day? Why should investors use regulated markets? What role do brokers play? And why is investor education so crucial? These questions help deepen your understanding of today's lesson. Let's recap the key points. Financial markets connect investors with businesses and governments seeking capital. Different markets serve different purposes. Prices change due to supply, demand, and broader economic factors. Stock exchanges provide an organized environment for trading, and regulation supports market integrity and investor confidence. Test your knowledge with a quick quiz. What is a financial market? Name 5 types of financial markets. What is the role of a stock exchange? What's the difference between primary and secondary markets? Who are institutional investors? What determines the price of a stock? What is a bull market? What is a bear market? Why is market regulation important? Why should investors verify that brokers are licensed? Before day 4, take on this assignment. Research the primary securities exchange in your country. Identify 5 companies listed there. Find one recent market event that affected share prices, and reflect on why regulated financial markets are important for investor confidence. This research will deepen your understanding and prepare you for the next lesson. Today, you learned how financial markets function, who participates in them, and why they are central to investing. This knowledge gives you a strong foundation for understanding how investment opportunities are created and traded. Stay curious and keep building your financial knowledge. Coming up next, risk versus reward. We'll explore what investment risk means, the the different types of risk and strategies for managing risk while pursuing your long-term financial goals. Understanding risk is just as important as understanding markets, so don't miss it. By completing today's lesson, you've gained insight into how financial markets operate, why they matter, and how they support economic growth. You now understand the basics of stocks, bonds, and other assets, and you're better prepared to make informed investment decisions. Financial markets are the bridge connecting investors with businesses and governments seeking capital. This connection fuels innovation, infrastructure, and economic development, making markets a vital part of our financial system. One of the key benefits of financial markets is liquidity, the ability to quickly buy or sell investments. This makes it easier for investors to access their money when needed and helps keep the market functioning smoothly. Financial markets offer a wide range of investment opportunities, from stocks and bonds to commodities and currencies. This variety allows investors to build diversified portfolios tailored to their goals and risk tolerance. By helping businesses raise capital and supporting job creation, financial markets drive economic growth. Healthy markets contribute to a stronger economy, benefiting everyone from investors to employees and consumers. Markets can be volatile, with prices rising and falling due to various factors. Understanding volatility helps investors stay calm during market swings and stick to their long-term plans, rather than reacting emotionally. Diversification means spreading your investments across different assets to reduce risk. It's a key principle for successful investing and helps protect your portfolio from market ups and downs. Making investment decisions based on emotions can lead to mistakes. It's important to stay disciplined, rely on credible information, and focus on your long-term goals, even when markets are unpredictable. Education is one of the most powerful tools for investors. By learning how markets work and staying informed, you can make smarter decisions and avoid common pitfalls. Keep building your knowledge to become a more confident investor. Before investing, always verify that your broker is properly licensed. This helps protect your investments and ensures you're working with a reputable professional. Regulation exists to keep the market safe for everyone. Major events, like economic reports, political changes, or global crises, can impact market prices. Staying aware of these events helps you understand why prices move and prepares you to respond wisely. Successful investors focus on the long term, rather than reacting to short-term market noise. By setting clear goals and sticking to your plan, you can navigate market ups and downs with confidence. Today's lesson covered the essentials of financial markets, from how they work to who participates and why regulation matters. You're now equipped with the basics to start your investing journey with greater confidence and understanding. As you move forward, keep exploring, learning, and applying what you've learned about financial markets. Each step brings you closer to building wealth through smart investing. Stay tuned for Day 4, where we'll dive into risk and reward.